see if Intel's fundamentals are actually worth buying, or if the company is worth buying right now at the current share price. So let's get started with this. Now, guys, earnings came out today, and well, they were expecting negative 14 cents, so that's already a problem. For the EPS normalized estimate, EPS gap, negative 65 cents, revenue, $11.13 billion, all revisions, all 30 revisions to the downside according to Seeking Alpha. Now, what actually happened was Intel EPS of negative 4 cents beats by 10 cents. All right, really good. Still in the negative though.
Better than their last earnings.
Better than the last earnings, but still in the negative. It's not something I'm not liking. So we're going to get an NA for the PE on the calculator for this one. And revenue, $11.7 billion, beats by $570 million. So overall, really, really good. And let's move into now their actual earnings release. And like always, this will be linked in the description below. So we got first quarter revenue of $11.7 billion, down 36% year over year. So once again, this is a case that just because analysts are saying, oh yeah, it's really, really good, it beat by 570, that doesn't mean anything. It really doesn't mean anything. You got to take a look at what the company's doing year over year. And unfortunately, revenue, it is down 36%. First quarter GAAP earnings loss per share attributable to Intel was 66 cents, non-GAAP EPS of 4 cents. Forecasting second quarter, so this is the guidance right over here. Forecasting second quarter 2023 revenue of $11.5 billion, so down from what they did this quarter, so 11.7 to now 11.5 in Q2. Oh, wait a minute, did I read that wrong? I am so sorry. I am so sorry for that one. Sorry. Forecasting revenue of $11.5 billion to $12.5 billion. So it's between 11.5 to 12.5. Expecting second quarter EPS of negative 62 cents for normal EPS, and then non-GAAP EPS of 4 cents. Now, looking at what the CEO had to say here, we got, quote, we delivered a solid first quarter results representing steady progress with our transformation. Boy, are they, are they really doing a transformation. We hit key execution milestones on our data center roadmap and demonstrated the health of the process technology underpinning it. While we remain cautious on the macroeconomics outlooks, we are focused on what we can control as we deliver on IDM 2.0, driving consistent execution across process and product roadmaps and advancing our foundry business to best position us to capitalize on the $1 trillion market cap opportunity ahead. Now, this is obviously based on the fact that they are planning to build an Ohio plant. And there's a lot of reasons for this. Mainly the US government is saying, we need you guys to build a plant here because we have fears of China invading Taiwan. And that's an actual fear that's happening right now. Now, if you guys have known me, I'm not a fan of the Chinese communists. I'm really not a fan of that. In fact, I'm a full-blown capitalist and cap. I'm not a fan of these people. So the fact that they are at least bringing the chip industry, which is huge, to the United States, that's major. That's a major milestone. So it's like, yeah, they're going to hemorrhage. But at the same time, is that growth worth the current price? That's always the question, right? What price are you willing to pay for future growth? So that's very, very important to see. Now, the CFO said we exceeded our first quarter expectations on the top and bottom line and continue to be disciplined on expense management as part of our commitment to drive efficiencies and cost savings. At the same time, we're prioritizing the investments needed to advance our strategy and establish an internal foundry model, one of the most consequential steps we are taking to deliver on IDM 2.0. And something about that too, guys, I believe they're like one of the only semiconductors. Mike, you know more about semis than I do because you're a tech guy. But I believe semis, or at least Intel, is the only semiconductor that actually builds its own chips. It doesn't rely on TSM.
Wafers, yes.
Yes, it doesn't rely on TSM, on the Taiwan Semiconductors.
TSM or Qualcomm.
Right. So that's really, really good, right? That's really, really good. So let's see what these revenues have to say. Now, revenue or at least what these financials have to say. We got revenue, Q1 2022, 18.4, I believe. Yeah, this isn't billions. 18.4 billion, Q1 2022. 11.7 in Q1 2023. That is a down 36%. Gross margin, went from 50.4% to 34.2, down 16.2%. We're only gonna take a look at the GAAP ones for this. I mean, we could take a look at the non-GAAP, so it's roughly the same. R&D and MG&A, 6.1 billion to 5.4, down 11%. Operating margin 23.7 to negative. Look at this, negative 12.5%, down 36.2 points. Tax rate we don't really care about. Net income loss and attributable to Intel, positive 8.1 billion Q1 2022 to a negative 3 billion in Q1 2023. That is down a whopping 134%. And earnings went from $1.98 positive to a negative 66. So that's really, really bad, guys. I mean, that's really, really awful overall. And we kind of already saw their, actually, we can take a look at their outlook right here. And, well, for Q2 of 2023, they're expecting between 11.5 to $12.5 billion. Gross margin, 33.2. Tax rate, negative 85. And earnings per share attributable to Intel, negative 62 cents. So roughly the same as what they did Q1. So not really much change. Now, let's come into the discounted free cash flow and take a look at this company. Ticker symbol of ITNC. Market cap of $125 billion. PE of 15.36 with a current price of $29.86. Now, this price, guys, is insane because, well, looking at this on the 5-year, we could see that, actually, we could see that on the max. Let's take a look at this on the max. Look at this. Their peak was 2000. Their peak was 2000. And Intel back then was absolutely bonkers, reaching $70 roughly. If I'm gonna, let's just say around $70 to $75. .com happens, and 23 years later, they never reached the $70 mark again. That's insane. What do you think about that, Mike?
Their high was 75.
The high was 75. Okay.
So here's the thing about Intel. It's like you basically had 2 lost decades, essentially, going basically nowhere for 2 decades.
You know why?
Well, one, because they didn't have competition back then when AMD and Atheon and all that, basically, they were clobbering them for years.
Easier answer. It's a much easier answer. Ready?
Yep.
You overpaid for growth. That's it. That's it. You can overpay for growth. And by the way, this is a company that up until, I believe, last year, their fundamentals look really good. Like, pretty consistently increasing. Yet, they still never reached that $75 mark. 23 years later, after that .com. Because you can 100% overpay for growth. So, with that said, guys, they do pay out a dividend, which I did not put it here, but let me bring this up for you guys. They do pay out a dividend of 50 cents. I believe they cut it. I can't fully remember if they cut it or not, but I believe that they did cut it.
I could have sworn I remember some news about that a while ago.
Right, that's why I'm like, I think that they did cut it. This is only a yield of 1.72%, a payout ratio of almost 80%. That's massive. And a 5-year CAGR of 5.5, so not that big with 8 consecutive years. But then again, I think that they did cut it. Let me take a look at the dividend history.
Yes,
really
they did cut it.
Right there. Yep. Nope. I see it right there. 37 cents to 13. Yep. They 100% did cut it. So this, they will lose this dividend growth years. So this will go down to 0, and most likely this CAGR is going to go into the negatives as well. Ex-dividend date is actually coming up on May 4th. May the 4th be with you. And payout date will be on June 1st. And they pay their dividends quarterly. Now, let me input this 50 cents over here for their annual payout. Not $50, 50 cents. And guys, based off of the current shares outstanding, they pay out almost $2.1 billion in dividends every single year. And, well, after this is paid, in their 5-year average free cash flow, they still have left $8.4 billion. And their last year's free cash flow, this is negative $11.7 billion. They cannot afford this thing they cannot afford this dividend just from their last year's free cash flow. Now, their 5-year average is still looking fairly good at only 20%, but their last year's free cash flow is negative 21.5. So that's very concerning to say the least. So let's take a look at these fundamentals. We got the net income, and I forgot to change it from last time, but we got the net income, $21.1 billion to 1 year ago of $8 billion, decrease of 62%. Give me a grade.
You could have left that 20 up there.
All right, I could have left that 20 up there. Personally, you can see a really steady decrease from 5 to 4 to 3 to 2 years ago.
Yeah.
and just the crash. So yeah, I would say 20% is fair enough. Now I know I said the fundamentals were good. The net income wasn't part of that. What I was mainly talking about was, well, at least from 5 years ago to 3 years ago when it comes to, I'm taking that back actually. I'm just completely taking that back now. Oh man, I feel stupid. Oh well, it is what it is. Yeah, looking at the free cash flow, guys, we got 5 years ago of $14.25 billion to a negative $9.62 billion, decrease of 167% with an average of $10.42 billion. Grade?
20.
Really? I would have given this like a 5. Me personally. Maybe a 10.
I put 5. I'm
maybe a 10.
Me in the middle of 10, yeah.
All right. Looking now at the revenue. We got 5 years ago of $70.85 billion to 1 year ago of $63.1 billion, decrease of 11%. Grade?
Let's see, 50%?
Yeah, I would say 50. I would say 50. You can see very consistently increasing from 5 to 2, which by the way, if you would have seen this company, you know, a couple years ago, yeah, it would have been very, very consistently increasing. It's just as of 1 year ago, that's just gone down. As of 1 and 2 years ago, it's gone down. So
yeah, it just trades like a dog.
It does. And assets minus liabilities, this was actually looking really solid, consistently increasing overall. Not any major downsides, like no major just dips at all. Average total assets, it is $164 billion. Average liabilities is $72 billion. Doing this difference, we get $92 billion in the positive. I think I should just keep the 85.
Yeah, I was going to actually say 90 just because you do have some dips from the trend, but it's actually showing significant strength.
All right. 90%. Cash flow minus the liabilities. I mean, their
You
cash
can
flow
keep
is
that grade.
decreasing. Okay, so I can keep the 0. And as of 1 year ago, it is negative $88.4 billion, which is a lot lower than the average of negative 56.84. So, I mean, it's just consistently decreasing 0%. And when it comes to the shares outstanding, well, this was good up until a few years ago. And you can see that they went from 4.52 billion shares outstanding to 4.137. That is a decrease of 8.4% on the 5 year. However, from the previous to the current year, that is an increase of almost 1 2/3%. You can see that they started issuing shares at the 3 year ago mark when COVID hit, going from 4.062 billion to then 4.07 and then up from there. So, what would you give this as a grade? This is pretty split.
50. Like, we're talking split 50, just because
50.
like they're relying on the share issuing to kind of bring some cash flow in, but it's not like their core per se, and they're not really trending in that direction, but they may be trending in it. So it's like,
right,
give them an opportunity.
Right. And lastly, cash and equivalents. They currently hold $11.14 billion with an average of $6.7 billion. Overall grades, guys, take a look at this. Net income 20%, free cash flow 10%, revenue 50%, assets minus liabilities 90%, cash minus liabilities 0%, shares outstanding of 50%, overall grade of 33. Main problem here is the net income and the free cash flow. It's really it. And of course the cash minus the liabilities, but that's because of the free cash flow. Guys, every investment is the present value of all future cash flow. If the cash flow is bad, you know, it is what it is. Now, what do we pay for this company? Unfortunately for me, I bought this company. My average share price is $55. And I'm not ashamed to say it. This is full disclosure, right? Full disclosure. And the current price is, well sub $30. However, I forgot to show this, that post-market after their earnings came out, they're actually up 5%, $31.35. Now, with the discounted free cash flow, not inputting anything, we get target share price of $31.15, not adjusting for debt, and $30.75 adjusting for debt. Now, the problem with these numbers, they look good, right? They look like they're pretty much on par with what's currently happening.
Yep.
Except, when we take a look at the growth, they're expecting a forward of negative 7.75%.
Yep.
That's a lot. And we just saw their earnings, and their earnings were pretty bad too. I mean, they're expecting another earnings loss overall in the next quarter. So again, this is negative 7.76. So grades.
Go back to their expected loss, because I do want to see what if their expected loss of 62%
on GAAP and then 4% non-GAAP.
Not 62 cents, and they were expecting what now?
Well, no, they're expecting 62 cents.
But their current earnings, they were expecting a loss of about
I
10
see.
cents.
I see. Yeah, it beats by 10 cents. Yeah.
So it's just horrible. That's just absolute. Their revenue and earnings are going to be horrible. So
Well,
it's like,
hang on a minute. So they got EPS of 4 cents right now. This is non-GAAP, and their non-GAAP for Q2 is the same, 4 cents.
okay,
Right there.
okay,
See that?
I see. Yes, I see.
So, yeah,
All right, going back to the expectation, you said 7% decrease,
almost
or
8%.
7.76. Let's see, low assumption. We're gonna do negative. We'll do -8, 7, and -6.
-8, -7, and -6. Okay. And for the projected share buyback,
So over the next 5 years, and
bring that
based
up for
on
you
what you
again.
had previously, I'm gonna say they're gonna issue 2%.
we're going to issue 2%. Okay.
Correct, on the low.
Issue
They'll
2%.
buy back
Okay.
0, and they'll and then buy back 2.
Okay. Well, guys, we get the target share prices now adjusting for debt of $22.70 to $25.50. Adjusting for debt, $22.31 to $25.09. Margin of safety of 5, 10, 15. Essentially $19 to $24. Yeah, this thing, I mean, I believe that we reached the $25 mark, if I'm not mistaken. The 52-week low, it was $24.59. So we were already pretty much there when it came to the highest assumption, I guess you could say, right?
Yeah.
So,
The low on the weekly was.
well, we'll get to that when we get to your part. Overall, guys, this is a company that I went over the 10K here on the channel. It's an hour-long video. I highly suggest you want to watch it, fine, go and watch it. But this is a company that if you want to buy it, you need to do your own due diligence. What we're doing here is not due diligence. All right, please understand that this is not due diligence. So all we're asking, guys, is just, use the calculators. They're available for free. The earnings will be linked in the description below. All we're asking for is, of course, like, subscribe, comment. It really does help, guys. Again, thank you so much for everybody watching here on YouTube. And, of course, Rumble. This is the most interaction we've ever gotten on Rumble. So, again, thank you all so much on Rumble. We really, really do appreciate it overall. And, this company, you guys need to do your own due diligence when it comes to this, and very, very thorough. To the point that, like, the janitor's name. Like, I'm not even joking, because this has problems. This has problems, and with AMD nipping at its heels, yeah, that's a problem. So, yeah, that's all I got when it comes to this. Now, I want to take a look at this dividend. Even though they did cut it, guys, don't buy into a company because of its dividend, but putting in $5,725 with the current dividends of 50 cents, this is $95.87. Guys, this is not a company you buy for its dividend. Absolutely not. Again, they cut it. So right then and there, that's already a really sour taste in my mouth. And on top of that, yeah, it's they have problems with their fundamentals. So with that said, let's move over on to Mike's technical analysis in regards to the company Intel.
All right, so looking at Intel, we're going to jump to the SMAs real quick. Everyone on the channel knows my opinion of if you're below the 200 weekly, you basically just don't bother with the company. Your 200 weekly sitting at $45.19. You are in the kangaroo, as I call it, and at $31.30, you are actually above the 50 daily. You're above the 50 weekly moving average, so you made some progress. However, that doesn't necessarily mean that you're out of the clear. We saw Intel push back above these moving averages and basically collapse right back down. So don't overextend quickly. Wait and see for the closure of the day to see what the stock is trading at. Now, if you close above $31.21, then I'd be looking more bullish versus more bearish on the company, or starting to look more bullish. So with that, basically, we do see on Lux Algo that you bounced off a price action zone. You were coming down pretty much into earnings. So they were expecting bad earnings, and they basically beat the expectation. So naturally, they're going to go up. You have a lot of gaps on the daily chart, especially coming up into this $31.80 all the way to about $31.50, or right where you're about to open. You could kind of fill some price action zone here, or price action in this area and then push up further. And Intel has the capability to run up at least to, I'm going to say, the $36 region. You have the RSI and MACD both supporting a run up. You haven't crossed yet, but on the open, if you don't just fade the entire gap, I definitely see Intel basically having a possibility to push higher. Semis have been very strong, and Intel has been one of the laggers in the sector. So you're basically going to want to keep that in mind, and maybe you see a rotation in the sector from NVIDIA and AMD into Intel, because, you know, people may be paying for that growth or wanting to rotate from one company to the next. That's very possible. However, Intel, basically, the stock trades like a dog, and I can't describe it any worse than that, just because it's just very, very sideways. There's different ways to take advantage of that, through options, through dollar cost averaging, different things that you can do to basically profit off Intel. But if you're just going for the straight share approach, it was an interesting point going into today. I do still think it's at an interesting point. When I say interesting, I'm saying that there's a continuation possibly in the company, but you have to have, again, proper risk management, do your due diligence. All that being said, for the downside potential on the company, if you come swinging back down and start taking out these lows, you could complete this bigger pattern of the A to B pattern that's on the chart, which we go A to B to the low, B to C to the high here, projecting down to the $17.50. And this green area is actually a price action zone that I've drawn out, which was Intel's basically going back to almost basically inception area that basically it had a massive bottom at. So again, just be cautious about that when you're basically trading the company. So now for the upside, I'm going to talk about the upside for a second. You do have a to B pattern on the way up. As simple as I can draw it here. From the recent lows to the high, pull back to its recent bounce, projects up into the $37.67 region. You do have a price action zone sitting in there between there and that point, so definitely don't necessarily run all the way there, but 35.78 is a 70% of that leg up. So definitely could see a push up higher. Now, again, if we go to the weekly time frame to see what it's telling us, it tells us a completely different story. You're not above the swing point here, so the MACD still has the potential to curl back down on you and basically come back down to this $25.55 region, which coincidentally coincides with one of the estimates that we have. And I'm basically saying you could get a tripling bottom on Intel down in this 25.24, or you can push down into the 20s, so somewhere in this region. You really would have to see the volume capitulation kind of downfall once you get down into this region on Intel, where people basically just completely sold out of it. But the MACD is supporting a curling down, and you could have continuation down to the downside. Monthly, you have crossed bullish, but again, the monthly takes such a long time, and you're going to basically have a failed breakout on the monthly, which closes tomorrow at 4 p.m. So then you're going to have an inside bar and basically trade sideways. And unless you can get above the high of the month, which would basically be the previous month's actually high of $32.90, you're at $31.30. So you have the possibility, I'm not saying you're not, but you definitely have to be cautious on that. Just don't go blindly into the company. Like I said, at the close, $31.33 is where you are right now. So basically just keep that in mind, that once you have to get above $32.90 is the region that you basically have to clear in order to have a continuation more to the upside, and then tackle that $35 price region. Remember, first step is get above $32.90. Don't just target 35 on the first bat thinking it's going to go all the way up there. Remember, baby step it up there. Once one of those things are violated, then you go and you pull back from your assumptions. So that's all I got for Intel.
All right. And guys, as I said, I am down a lot on Intel, but it is what it is. You know, I'm personally not going to sell, because I think that they do have a future. It's just that right now it's a little bit rocky. Maybe in the next 20 years they'll beat their $70 mark that they did in the .com. But yeah, I think that'll pretty much do it when it comes to Intel.